All right. Well, thanks everyone for joining. Um, for quite some time, we've been looking for ways to achieve, significant tax savings for many of our clients.
I'm just joining an attendee.
Okay, cool. Thanks.
All right, we're gonna roll. So now it's 2:01.
All right. From our technical difficulties, we're good to go.
That's right.
All right.
Very good. Glad to have everyone on with us today. So far.
All right. Well, thanks everyone for joining. For quite some time, we've been looking for ways to achieve, significant tax savings for many of our clients, outside of the typical tax strategies that we do all the time, but looking for maybe something that would take a bigger swing, get some bigger tax savings, especially, for example, clients have some transaction that year, maybe they sell a building, they have a large capital gain, and they're looking to us to say, how can I take a big swing, save some taxes, keep more of my cash. And that led us to seek an additional specialist to implement these strategies in a way that is successful and also protects the clients from IRS scrutiny. So that's where Dale and Jake come in. we have a team, and for instance, Jake, he's not just a financial planner, but he works with CPA firms, across the country to help implement these high level, tax advantage wealth management strategies for their clients. So for our clients, so it's great to have these two as part of the team to help achieve that. But Jake is passionate about advising successful business owners on these strategies, and that were once thought for the elite only, to bring them down to everybody that could, it's in that situation that could use them. So, with his background and degree in accounting, Jake has extensive business management and accounting background. So he understands how to mitigate taxes and in the future can impact the client's net worth and asset accumulation, which is what it's all about. So, welcome, Jake. And I know Dale, I don't know if you have anything to add to that I missed.
Yeah,
Appreciate your kind words and giving a little bit of background of who I am and what I do. I have just a few slides to talk about that a little bit more and then dive right into today's agenda. If you allow me, I will go ahead and share my screen. All right. How do we supercharge your tax savings? And we do that with these higher level tax strategies that we help CPAs, financial advisors, tax attorneys, merger and acquisition attorneys all over the country with. And why do we help them? Why are we needed? To the common person, it might sound like, well, shoot, an accountant, this is their job. But to be really honest, we have to know and understand what people do in their day-to-day. And if they don't do that for 100 other clients, they should honestly and morally reach out to somebody who does and bring them into the mix to better serve the client. That's why people come to me. I do the stuff that most people don't do every day. And as Dale mentioned, I do extensive due diligence to ensure, I say ensure, to at least as much as I can ensure we can mitigate the risks of people participating in some of these tax strategies or investment programs. What made you decide to be here today? That's kind of something that we should ask. And if you feel like posting a few comments, we are doing a little bit of a presentation panel discussion before Q&A. But as we're going throughout, there's a little chat box, there's comment question box, Q&A. Feel free to start posting comments and questions so that we can touch on those throughout the presentation, as well as address those during the Q&A. Many of you are probably here because you may feel like you're actually working for the IRS or working in such a way that you're optimizing what they receive rather than optimizing your tax savings. And we're able to help flip the switch on that and help you take advantage of perhaps some strategies that you've not taken advantage of before that are clearly available to most people who are paying 50, 60, 100, 200, $1 million in taxes. And if you fall into those categories, we can help you. That way you can keep more of your hard-earned money, and you can do the things today, March 27th, that will help you during 2025, during the 2024 tax season deadlines, save hundreds of thousands of dollars in taxes. That's why we're here. You might be wondering if this is really for you or not. Well, helping you know and understand. If you're living off of portfolio income, retirement income, or investment income, if you are a business owner and as an entrepreneur, own your business or have a high percentage in the business that you operate, or if you are a W-2 income earner who is earning, let's say, 600,000 or more, paying 100,000 or more, or 50,000, what have you, depending on the state, depending on what part of the country, depending on how your income is received. This definitely is for you. If you have multiple businesses and you're trying to also consider how to structure the next move or business venture, this is also for you. All right, no matter where you're at in this picture that I just explained of all these different types of people, now is your chance to regain control. We have a common saying in my office that we don't want to leave life to good luck and to chance. We don't need to be a betting man. There's a lot of things we can do to mitigate the negative possibilities by planning ahead and implementing things today to help us not have chaos later in life and not have high tax burdens, but to help us gain control over our financial future, including that of tax. All right, why am I here and what made me who I am? A few impactful things in my life. I got a degree in finance and then immediately went out on my own. I didn't go and work for one of the big four, or I didn't go and work for Goldman Sachs. I had offers. I had professors trying to guide me in that direction. But being more of an entrepreneur and because of life circumstances, I had to figure things out myself. That was perhaps one of the first impacting things. While working full-time and taking the credits of 2 full-time students, and I'm only one person, finished a master's in business, which is here, and as well as a master's in accounting. Later on, as I'm helping my clients, I relied on creating alliances with other professionals and learned how to work really well with others. In that same timeline, I was also, I want to say, betrayed by other professionals in the sense that some of the strategies and things that I brought to them, they then took to other people who made money off of providing those services rather than me providing those services. And so I dug my heels in deeper and I studied harder. And that's why I'm very much a nerd when it comes to doing due diligence. And when I say a nerd, I say that in the best of ways, because as is mentioned, I go to the drilling sites and I don't just talk to the fund managers, but I talk to the fund operators, or in a oil and gas drilling fund, that would be the drillers. And then I go and talk to their engineers, and then I go and I physically touch, see, and smell. That sounds strange, but they have what's called the sniff test in the IRS, right? So sometimes it's really important that you validate that things are real, not only because your clients are putting their money there for an investment, but your clients are also putting their money there for a tax deduction. And we want to make sure and ensure that, hey, they've done this in the past. And not only have they done it, they've done it well. They're not the newbies, they're not the cheapest people around, but they are perhaps the most efficient. But these are the things that we look for, best practices in every industry, so that we can check off all the boxes. And if, of course, anybody ever asks us why we did this thing, you can do more than just say, hey, that guy told me to. We did this thing because I fully understand and comprehend there's been an ample amount of due diligence, as well as, you know, my accountant, my CPA, and this other guy named Jake all agree that it's a good thing for me and that I should have this expected outcome. And then a year or two later, they have that outcome. That's very powerful. And that's why a lot of clients come to us, because we work together as a team, several different professionals, so you can do something higher level than you did in the past by just using one professional. There's a number of different accolades that I have throughout my career in helping people build funds, helping people build strategies, create things that are perhaps one-off, as well as strategies that many people can participate in. And here we are in 2024. We're ready to get going. We're ready to do some really great things. We have a couple strategies that I'd like to just dive into right away. I don't know if Todd or Dell, we should mention anything before I dive into 5 strategies for the day, and then we're going to jump into Q&A. Okay, just so you know, you're both on mute.
That would be great. Sorry.
No, you're good.
Sorry.
You're good. You're good.
Yeah, sounds good.
Because we're touching on so many strategies in a very little amount of time, it's going to be just a taste, right? So if we're in the kitchen, we're that little kid that sticks his finger in the cake and walks away, right? That's what we're doing right now, just a taste. High level, there is a tax strategy that is only for business owners. Business owners that have minimum of $1 million in revenue, gross revenue. A lot of consultants fall into this category because they also have high margins. Marketing specialists, consultants, salespeople, tech companies. Now, getting into higher revenues, people who are making 5 million, 10 million and more, manufacturing companies, serial entrepreneurs, people that maybe have multiple businesses, and collectively all of the businesses do a substantial amount of revenue, and even though the margins might be small, the volume is large. Why is all of this important? What do they have in common? They have a large amount of disposable revenue. Not all their money's locked up. And they have a very large amount of taxable revenue. What can we do there? There is a strategy where the IRS literally allows you to put money away for a rainy day. That almost sounds too good to be true, right? Because outside of like an IRA and a 401k and these retirement plans that are very restrictive, meaning you have to be old to participate to get money out, right? There's not a lot of different ways that you literally can just deduct money from your businesses, lower your taxable income from these businesses, money that would otherwise pass through to you in a K-1 or as a dividend or something of that nature, money that would otherwise come to you and be taxable, they're allowing you to put it away for a rainy day. What is a rainy day? Business risk. What could happen to a business owner? Well, my goodness. Recently, there's been a pandemic. That's never going to happen again, right? There could be business interruption. What could cause a business interruption? A presidential legislative changes, natural causes. What if, what are the most common things that we think of when we think of business risk? Well, competitor buys out my supply chain. Now I no longer can use my supply chain. Cyber breach, now more than ever before. Technology is getting better and better and better, which also means the bad guys are getting better and better and better at what they do, which means that we're more and more at risk, right? So all of these things, theft, fire, burglary, fraud, et cetera, are things that could damage or cause risk or harm to your business. And you, as a business owner, are able, through this strategy, to effectively, if things are structured and set up correctly and money transfers the way that it should, deduct up to 15%, I say 15, very conservatively. That number is actually not written anywhere, but it doesn't set off any red flags or cause any IRS person to raise their brow when you do 10, 15% of your gross revenue. Again, if you're a manufacturing company, maybe your net revenue is only 20% of your gross, right? So in that scenario, almost everything that you're bringing home, if you don't need it and you have the liquidity, you can take it out of your right pocket, put it into your left, and qualify for a deduction from your companies, a deferral on that money. You got a deduction right now, you're lowering your taxable income. You get a deferral on that money. That money, at some point in the future, if it's not needed for a rainy day, you're telling the IRS that I'll pay taxes on it at some point in the future. However, one additional thing that is really cool, you get a recharacterization of tax status. Got a deduction, got a deferral. When I do take it out in the future, it won't be taxed at ordinary income rates. Like under most circumstances, it would be today. It would be taxed at qualified dividend tax rates or capital gains, which currently are the same tax rate, at preferred tax rate. Federally, if we're in the highest tax bracket, that's saying, hey, by just flowing through this strategy for 1 year, I go from the 37 to the 20% tax bracket. All right, immediate arbitrage or a delta for you. That's good. In addition, something else, this bucket of money that we're just setting aside for a rainy day, should we need something in the short term, interim, what have you, you're allowed as the owner of this bucket of money to take out an owner's loan. And so it's accessible to you after the holding period of 1 year. So what have you created for yourself? An asset that you would have otherwise used to pay taxes with. You now have access to this asset via loan, as well as in the future, should you want to pay taxes and be done with it, you have a recharacterization of tax status, you have a recharacterization of tax characterization and can access it at a lower rate. Now, with more thorough planning in the future, you can do other things to mitigate the tax hit of taking it out later. What you're buying, in essence, is time, as well as a deduction and deferral, which is just magical. This is one of our phenomenal business owner strategies. Now, let's just jump into the other extreme of things. Let's say you're not a business owner. You can be a business owner, and you might have substantial income coming to you, but you might also just be somebody living off of portfolio income. A recently deceased spouse that has rental properties and money just coming to you. Or you might be in the workforce and you make more than perhaps the average American. You might be in California, Silicon Valley. I have some clients there that are making between 400,000 in W-2 and 2.5 million in W-2. In fact, shoot, I have one client that has a portfolio of company stock worth $30 million. All right, so this next thing might be for all of you people. And that's where you're able to turbocharge a charitable deduction. A charitable deduction. Now, this is a little bit different than putting money that you would otherwise pay taxes on into a bucket for yourself and get a deferral deduction and recharacterization of tax status. This strategy is, hey, I can go down the street and give my money to my church, which I'm going to do anyway, regardless. I'm not telling you not to. I want you to remember what it's like when you give money to the church down the street. You give $1 to them, and you're going to save federally, if you're in the highest tax bracket, 37 cents. Meaning, what you would have owed decreases by 37 cents. You had to pay or spend $1. And so obviously you're not doing it for the tax breaks. You're doing it because you're philanthropic. You want to help the local community. And one way to do that is to give money to the church or the Goodwill store or to some other foundation. In this scenario, you get sometimes a turbocharged or a multiplied tax benefit. Now, we're not talking about conservation easements or some of those other items that are like very highly contested because people do them the wrong way. I'm not saying that they're wrong. There's plenty of people that do them. In fact, there's an ex-president who does them every other year and does them right and gets the deductions. But I'm not talking about conservation easements. I'm talking about when you help somebody who is in a philanthropic process, but maybe bigger than you or bigger than the local church or bigger than what you've done in the past. You're going to help them throughout the process because they're actually producing a thing, I'm not just giving my church money and I let them decide what to do with it. Now you're taking the money and you're going to participate with somebody and you know exactly what they're going to do with it. In this current example, this last year, we helped many individuals with fertilizer in the country of Haiti. Now, they helped out with an earlier stage. They didn't just go to the store and buy a bunch of bags of fertilizer and send them to Haiti. What happened to Haiti a dozen or so years ago, all of us went to the grocery store. We bought water, we bought unperishable things, we bought toilet paper, we bought a lot of stuff. And we sent it on airplanes and helicopters over to Haiti. Now, with a little bit more planning and preparation, we can get a multiplier on our tax deduction for doing the same thing. But instead of buying that already repackaged 50-pound bag of fertilizer, what we're going to do is we're going to buy part of the mountain. So Todd and Dale and Micah and the rest of us, we're gonna get together as a group of people. I'm gonna put in 50,000. Todd, he's gonna put in 100 because he's a really good guy. Dale, he's got some friends and neighbors and family, and as a group, they're gonna put in 500,000. Micah, she just loves people to death, so she's gonna beat us all. She's gonna put in $1 million. All right. And what is that gonna do? What is that gonna do? Buying the dirt from the mountain, there's a process, and that dirt needs to be refined, processed, packaged, put on pallets at the dock, and then a certified appraiser that is able to, with his stamp, certify the fair market value at a wholesale, not retail, but wholesale pricing structure, comes and declares that it's now worth 4 times what we spent for the dirt in the mountain. Now, not all the dirt in the mountain's there, because remember, it was filtered, strained, sifted, packaged. And there were some other things added to it to make it really good fertilizer, depending on what part of the island it needs to go to. All right, so obviously the finished product is worth more. If this were a manufacturing company, think of like the raw bare materials, and now we've got screws and lids and wheels, and we've got a new widget, right? The new widget we can sell it for more than what we paid for all the things that made it up. In the same sense, dirt from the mountain cost X, and now the finished good, based on another holding period of a year, inventory, all this other stuff, checking all the box for the IRS for this type of deduction, you're able to write off typically 4, sometimes more times what you paid. So Micah, being super philanthropic, she's got a $4 million deduction. Now, Micah, depending on her income, may not be able to take advantage of all that deduction. Again, she is the good one out of all of us, and she just wants to give to people. So she is limited as a non-cash charitable contribution to 30% of her AGI. So if Micah only made $2 million that year, and she's got a $4 million deduction, she's got to roll over the next 5 years, a large amount of that $4 million, so that it can offset every single year only up to 30% of her taxable income, right? So there needs to be some planning in place. Unless you're incredibly philanthropic and you're doing it for the good of the people, if you're doing this for the tax deduction and also donating to your church now down the road, then sitting down with Dale, Todd, a member of our team, you can sit down with these individuals and calculate out, okay, if we put in X and we get a 4 times multiple in the deduction, are we superseding our 30% of our AGI threshold? And if we are we okay with that? If we are, we acknowledge that roll, we don't lose it, it just rolls over to next year, right? So this is how, let me tell you about Jim. Jim in California had a taxable income of $1 million, a little bit more. He participated in this deduction. We calculated for him, saying, hey, if you put in 100,000, you're going to get a $400,000 deduction. You're going to exceed the 30% threshold. He says, I don't want to do that. Okay, let's decrease it. What if we did 75? 75 times 4. Now we've got 300,000. That fits on $1 million. 30% of $1 million is 300,000. 4 times 75 is 300,000. We are matching what his threshold is. So we've optimized how much he can deduct this year. And some people are like, hey, I want to have a little extra. I want to plan for 2 or 3 years. That's fine. But Jim did not want to. He wanted to plan perfectly with how much he could get from this one strategy, so that as he's considering oil and gas, as he's considering, all of these other tax strategies, he's able to optimize each one and not do any excess for 1 year, because every year there's going to be something else. So that's what we did for Jim. Hope that's helpful. By the way, we have a website where there's a lot of these strategies if you want to go into them in deeper detail. It's called strategictaxsolutions.com. And if you want to know if any of them are really right for you or how they work or what have you, reach out to Todd, reach out to Dale or Micah, right? And they will kind of let you know if it makes sense or not. And if it does, but there's some complexities involved, like life typically is. They say that anybody's life is actually just a financial mess because there's a lot of numbers. And it takes an artist to pick up this mess and turn it into a piece of art, right? Well, numerically, and I'm not talking about myself so much, but the other individuals here are your numeric artists and can help you put together this work of art, which is your financial life. We have another business owner. I'm going back and forth here, right? Now, this is a business owner tax strategy. And to be eligible for it, this is called the Restricted Property Trust. What is that? Think of a retirement plan where you are able to discriminate against other employees. That almost sounds bad, right? But it's not. A lot of times, business owners are doing a lot for their employees. They're doing health insurance, 401k, defined benefit plan, and they're looking for something more. And there's nothing else. Well, now there is, and there has been for about 23 years. This restricted property trust allows individuals to fund. When I say trust, I want you to recognize that a 401k and a defined benefit plan are also a form of a trust. There's more types of trusts out there than there are flavors of ice cream, right? So don't get confused when I say trust. It's a retirement plan. It is a retirement plan usually just for the owners and or officers. So highly compensated people, where if we compensate them any more through these other retirement plans, we're going to fall into regulatory problems because we have to fund everybody within certain actuarial formulas. And if we fund some people too much, it ruins the formula for everybody else. So the 401k, we can do so much. There's the defined benefit plans, and then there's the restricted property trust, which oftentimes is like the next thing. In fact, some people do the restricted property trust rather than the defined benefit plan, depending on the circumstance. This is very common when you have like a one owner business or an owner with a handful of employees, right? But the owner is like the main breadwinner for the company, and everybody else is like assistants and things of that nature, right? So there's a huge income disparity. Or most recently, companies like Nike that are publicly traded that are doing something like this for their employees, all right, for their officers. This strategy, you have to have a taxable income within the business of at least 600,000 for you to be eligible. 600,000 taxable comes from the business. So if it's like an S corp, flows 600,000 flows to the owner, right? This cannot be done for a sole proprietor. So this has to be an S corp, C corp, or at least a partnership tax return to be eligible. Now, we have had several clients that have converted from like a sole proprietorship to an S corp, and in that same year, because they had so much income, they did this strategy. That does work. The income at that threshold has to be so high so that we can, this strategy is doubly beneficial because the asset or the investment inside of the restricted property trust, think of like RSUs for these tech companies in California. If you're a W-2 employee, you get RSUs, you get taxed on them, things of that nature. This being a little bit different, you only get taxed on a portion because you are funding an asset that is a life insurance policy, usually on the life of the owner of the company, inside of your retirement plan. You fund it for a minimum of 5 years. You can fund it for longer. Oftentimes there's like a 10-year, 8-year, 12-year break even where you've put more money into this asset than it's cost you. The benefits here is that you're deducting oftentimes up to 70% of the money that you put into like a glorified employee compensation plan, right? But it's typically for the owner or high-level officers. You're putting away all this money, and here's the big kicker. You get it. You pay a little transfer tax to get it out of the trust. You terminate the trust, and the owner gets it tax-free. So you've used something that almost doesn't work anywhere for business owners. You use taxable money, and you just paid a little portion of the tax every time that you did it. You use taxable money, and you got a deduction for putting it into a retirement plan. You funded this retirement plan, let's say 5, 10, 15 years, however long, and you took it out of the retirement plan, and you get to now use it tax-free. So everything that grew into, because it's a life insurance policy, the whole become your own banker, bank on yourself, or essentially just have a lot of money put away in a tax-free, like a Roth IRA type scenario, you now have. And you built that with money you would have otherwise had to pay taxes on. All right. So very rarely anywhere are you able to get a deduction and then get an asset that is tax-free. In this scenario, you can. This scenario has been tested several times by the IRS, meaning they've audited it, they've tested it, whatever. To date, they're doing wonderful. They have not failed before the IRS. And so that is why bigger companies like Nike and others are looking into them very strongly. Switching topics back to what now anybody in any of these categories, business owner, W-2 income, employee, portfolio income, person can do. And that's invest. Now, depending on what you invest in, there may be tax benefits. You invest in real estate, you get depreciation. You can do a cost segregation and accelerate your depreciation. You invest in renewables. There's certain renewable tax credits based on the state in which you live, as well as federally, as well as there's depreciation. You invest in oil and gas. Oil and gas is perhaps one of the more for sure and highest percentage that you receive in tax offset. And that's because of IDCs. Back in the year 1918, which was a long time ago, I don't want you to get bored. Todd, if I get boring, let me know. But, you know, not to be a monotonous professor or anything like this, but way back in the day when our country thought that maybe we'd go to war with some of the countries that we rely on for oil specifically, said, we need to incentivize the wealthy Americans across our country because as a country ourselves, we don't really tax our citizens. It was 1918. It's like we don't tax a lot. So how do we encourage the wealthy that we do tax? Now that is also why we left, you know, Great Britain and England, right? Because taxes. So we still hadn't really gotten heavy into taxes by this time, but being afraid that as a weapon of war, these countries that send us oil might just shut off our supply and cripple us as a country. They said, hey, the highest income individuals who do pay taxes in our country, let's give them a break. If they help us with the most expensive stages of oil and gas discovery, which is, you know, before we had satellites that can do imaging into the ground and tell us where aquifers are, before we had these machines that can do imaging as we go drive across a road in a vehicle or drive across the bushes with a vehicle, whatever, and find out what's underneath, what kind of metals, what kind of sediments, what kind of liquids are beneath our feet. Before we had all of this technology, it was incredibly expensive. We literally had to like pop holes in the ground all over the place and find out what came out. And even though technology has changed dramatically since then, the tax law has not. Since 1918, we have what are called IDCs, intangible drilling costs. If your investment in an oil and gas fund gets spent in such a way that the operator, not the fund managers, but the operators invoice for things that go towards finding an oil reserve, and even everything that includes the bit going down into the ground and touching the oil so that we can deem that there is oil there, that goes towards an IDC. Most operators are rather efficient, and as much as 85% of your investment gets allocated. Most recently, a lot of our recommendations have been 90, 91, 93% IDCs, meaning most of your money gets allocated to IDCs. Some of our clients get what's called a roll-up. What is a roll-up? That means you pay your fees in such a way, oftentimes not through a broker-dealer, to where more of your investment is allocated to the actual drilling. And you say you put in $100,000, but now you have a net asset value first year of 106 or 107. So it's almost like you made money out of thin air. And it's not that you did, it's how these funds are set up. They're made to pay high commissions to broker dealers. But if you are able to invest in a way outside of that, you not only get the tax benefits, but instead of getting tax benefits on, let's say we do really well, and it would have been 90% IDCs. Well, now take 90% of $106,000 or $107,000 investment because you get the roll up because you didn't pay a commission to a broker dealer. 107, 90% of 107 is 96,500. You just amplified your deduction, got a lot closer to 100% because of advice that we bring to you, because we're charging for our advice. We don't have to rely on commissions and other things that other people pay. And so we're here to help provide you with the unbiased, I say unbiased because we don't have all these ulterior people paying us through different ways. If you spend more, spend less, or buy a certain way. We can give you all of the options, which is why CPAs love us, because again, what assets land on your balance sheet ends up being better, stronger, bigger, whatever, based on the money that you spend. At the end of the day, our goal to align with your overall outcome or what you want to accomplish is that you increase your net worth by having good investments and optimizing your tax savings, meaning optimizing how much you're able to reduce, deduct, defer, or recharacterize. So that's a little bit of who we are and what we do and what we offer. Throughout the year, there's an additional number of what are called leveraged tax deductions, as well as laddered, they're not bonds, but laddered lending structures. What does that mean? Where you give a loan, let's say, Todd, you've got an amazing project out there. Let's say that you're raising money because you're getting precious metals out of the deep sea. Sounds exciting, right? You're going to issue a series of loans to help raise money. And these loans, you're going to structure the payback so that it's principal first and interest last. Why would you do that? You're going to structure it to where it's principal first and interest last because at the end of the day, all of the return of principal, you don't have to pay taxes on in that year. And it allows you to plan on that final year when it all comes back as interest. So what we've done is we've decided that, hey, I want this cash flow without any taxes for a period of time. And then when I can have a couple of years to plan how to mitigate it, I want all of that taxable income to come all at once when I can do an oil and gas investment and offset it again. Something like that. And so there's a number of different things that can be done based on your specific and personal and individual need. The leveraged deductions, that's where somebody else has a project. Micah and Todd, they have projects. Micah has all of the assets and a lot of the cash flow. But because of other things, she doesn't need the deductions. So Dale, who's just a W-2 employee, let's say, he needs the deductions. Micah is the serial entrepreneur. She has the assets, she has the cash flow, and she has a lot of depreciation, let's say, or cost of goods sold that she doesn't need. She effectively enters into an agreement with Dell, and Dell is able to benefit through partnership rules from those offsets, income offsets, the depreciation or the cost of goods sold. Dell can take those where Micah doesn't need them. And the incentive here is that Dell gives Micah some money for that. So there's what are called leveraged deductions, which are all built differently. And they're not available at any time, like a lot of these other investments, like oil and gas. Anytime after June, you've got a lot of options. These leverage deductions, it's when people are doing a project and it's until that project's fully funded, it opens, it closes. This year, we had one open in February, it closed the end of February. Short period of time. So you kind of have to be attentive. If you want to participate in one of these other leverage deductions, just, when it's available and if you can get in before it closes type of a thing. And that's why we're here to let people know what's available and when. And that's why people sign up for our newsletter. They want to know what investment opportunities are available and what tax benefits come with them, so that throughout the year, as they have liquidity or as they have cash flow, disposable income, if it makes sense for them based on tax planning that they're doing with their accountant and their advisor and everybody else, if all the stars line up, then they can take advantage of in the moment of, because we're informing them of what's available, the due diligence we've done on it to vet it before we send it out in our newsletter, as well as, based on your specific situation, doesn't make sense. And so with all of that, I think I'm done presenting for the moment. I think we're open now for Q&A. Micah, if you're moderating this, let us know if anybody's asked any questions. And if not, we'll turn time over to the panel. That means that Dell and Todd will be unleashed and they can ask me anything they want.
All right. Looks like I don't have any in the chat right now, but I do have a poll question that would be fun to kind of put up.
Let's do it.
All right. Actually, in the meantime, I'm gonna go ahead and put this up, but want to kind of know a little bit more about each of you as far as what kind of best describes you as in your tax journey. Are you that basic business owner or just a basic individual that is looking to reallocate up to $7,000 of taxes? Are you a business owner? Are you not a business owner? Are you a high net worth individual or maybe there might be just an event that's happening in your life that you're aware that it's going to cause a tax ramification that you're needing some help with. So let me kind of post this up here and see where you lie. Okay.
Let's do that poll. And while you're doing the poll, I know that I really was jumping all over the place from like W-2 income employee to somebody living off portfolio income to serial entrepreneur, big business owner, small business owner, whatever. Todd and Dale, what questions do you think that your network of people have that maybe I should answer right now?
Well, just to piggyback on that, I mean, and you got to think of it where you could use multiple strategies to try to achieve the goal. So you got to keep that in mind as well. But a lot of times, clients come to us when they do have an event. You know, I sold my business. I have ordinary and capital gains. You know, much big ones usually, or I sold a building, and but you got to even think of it as if your business is doing well and you know that pass-through income is flowing over to you and you have disposable cash, that's where you can do some big swings as well in with these strategies and generate these deductions or losses to keep more of that cash and pay less in taxes. So you got to keep those scenarios in play. So it's not just for an event, I guess, is the bottom line. But that's when it usually comes up.
So whether they have ongoing, really good cash flow, really good margins, or a one-time event, like the sale of a business, the sale of an asset, an inheritance, what have you. You know, there is something here that we didn't touch on at all. We talk about all the different taxes, income tax, federal, state level. Not all states have it, right? But then there's the use tax, like sales tax. You know, if I go to the store and I buy stuff, there's that sales tax. Sometimes there's city taxes. A lot of different taxes. But most people forget about the biggest mousetrap that the IRS really has, and that is the death tax.
Mhm.
The death tax, which could be another 40% on the estate, depending on how your planning is done, which shoot, pay 30, 40, 50% on your income tax. And then when you die and you hand stuff over to your kids, if it's above the certain thresholds, which change every year, then that's an additional 40% haircut. It's really hard to pass things on without proper planning. Unless, of course, you're constantly, yearly or every 2 years, having a review with your attorney, as well as your accounting team, as well as any and all other advisors that might be able to help you make this journey more effectively. And so keep that in mind, that as we're doing planning for today and tomorrow from a tax perspective and from an income perspective, that we need to be planning for the legacy. And the legacy might be for a charity, might be for family, might be for the business, might be for your employees. But your ability to control that money after you go away is crippled if, of course, you have to give away 40% of it to the government needlessly. I say that because there are other options that are legal and moral and ethical. You just have to find somebody who helps people with those options every single day, to meet with your people that you know, like, and trust, and with you, so that we can come together with a plan that works.
Yeah, that's really what it's all about, just using each specialist, so you know, of their expertise to really create a good plan that really achieves your goals. And usually that revolves around keeping more cash in all this for yourself.
Sure.
So Jake, there is a question as far as the return of what a person can expect on oil and gas. Now, I know there's a lot of different kinds of players out there, and there might be different IDCs that people can get. So why don't you speak to that a little bit more?
Absolutely. Now, I'm going to speak in general. I'm going to take this big playing field of oil and gas investments. I'm going to narrow it down to what I'm going to talk about right now. So just so that you're aware, what I'm saying is not applicable to all oil and gas. Some oil and gas focuses on depreciation. That's not what I'm going to talk about. The oil and gas that I'm talking about are those funds that are put together by fund managers that want you to get IDCs, intangible drilling costs. There is something called depletion that oftentimes does not come necessarily on the tax forms, but your accountant, whether it comes or not on the tax forms, your accountant should be adding depletion, because what you're buying shares in is not the equipment, but the actual well. When I say the well, we're talking the aquifer, the percentage of the aquifer under the ground that is associated with this well. That is what you own, and over time it goes to zero. So that means it depletes or it goes away. Meaning you buy 100,000, you get a roll up to 107, if you buy it correctly. And then every year on your K1, it shows that that net asset value of 107 goes down to 86, goes down to 45, goes down to 32, goes down to almost nothing. At the end of average lifespan across the United States, 8 to 10 years, or in specific areas of Texas where we're currently at with some of our drillers, 12 years. Now, to answer your question about revenue on this type of investment, not the others. On this particular type of investment, the first year, you don't really get anything, because you invest your money oftentimes in the fall, but they haven't injected the money you gave them into the wells. They haven't deployed the cash yet. So the first year, for you to get a deduction, you're typically a general partner. You put your money in, and then it gets deployed over the next 7 to 9 months. So in 2024, if you put your money in June, July, September, whenever, it pretty much just gets held until January 1 or shortly thereafter of 2025. They then have the next 6, 7 to 9 months to spend your money and deploy it into wells in a way that qualifies as IDCs as best as they can. A lot of operators around 80, 85%. You choose really good operators, efficient, and spend your money the right way, you get closer to 90. All right. As that money is deployed over 2025, you might get a little bit of income if oil and gas prices are healthy. Some of those oil wells, now again, here's a really important thing. If you invest properly, according to best practices for investors in oil and gas, you're not investing in one well all yourself. Your money that you put in gets averaged across several wells that are all being drilled at once. That way, your $100,000 gets diversified. Industry best practices say at least across 7 wells. Some of the operators we're choosing, your money gets averaged across 20 or more wells. So even more diversified. That means if any one well is dry, you're not heavily affected. All right. So to answer your question about revenue, I'm going the long route, but I'm educating you along the way. So don't get bored on me. We're investing the money, it gets deployed. Oil and gas wells are being drilled, takes up most of the year. Some of them do produce oil that is stockpiled and eventually sold. So a client of ours who invested in 2021, 2022, they received on a $100,000 investment, $14,000. And it was just oil and gas wells that came on, oil wells that came online at the end of the year. Now, 2023, again, they invested in 2021, 2022, it was deployed and there was some revenue. 2023, they received $46,000. And again, they invested $100,000. Took a year. I guess the next year they got a little bit, right? Then they got a really big check, 46. Now, 2024, we're not all the way through the year, but I'm guessing that 46 that they received last year, they're going to get maybe 35, maybe something less. Because again, they're depleting the aquifer. The more they drill out of the aquifer, the less pressure is in the aquifer. In the beginning, they almost don't have to pump because there's pressure. As the aquifer depletes, there's less pressure and the pump has to work harder and they can only pull out so much. As it depletes more and more and more, it's more difficult for the pump, and eventually, every year you should expect a declining curve. From that second year, you got the 46, then maybe 35, and then ongoing, it should continue to decline to the point where after year 5 or so, it's pretty minuscule of what you receive. You'll continue to receive until maybe year 10 or 12. income. In fact, some people receive little teeny tiny checks that they just post on the refrigerator because it's cool that they still receive money like 20 years later from this oil and gas well. But your typical useful life, in fact, most of the time they dismantle the pump because it costs electricity and everything else to keep it going. And so oftentimes they do that at year 10 or year 12. Your typical lifespan, 10 or 12 years, 8 years if you go across all over the United States. In Texas, 10 to 12. And you should expect revenue kind of like I mentioned. A couple things that can interrupt the revenue, as I mentioned. So first year, you spend money, you get deductions. Second year, you get a little bit of revenue. The year after that, you get substantial revenue, and then it depletes and it decreases throughout the rest of the paying years. What could interrupt that? Oil and gas prices worldwide. If the low-cost oil-producing nations, Saudi Arabia, Russia, various parts of the Emirates, if they flood our country, which of course we're not buying from Russia right now, with cheap oil, that could affect domestic oil prices. And oil operators will do one of two things. They will stop pumping, which is actually harder on all the pumps, harder on all the machines. Or they'll continue to pump, maybe they slow it down a little bit, that they continue to pump and they just stockpile, warehouse all the oil until prices come back. That is the most likely scenario that'll happen, but that would influence your cash flow. So if that were to happen in 2025 or 2026, then instead of some of your biggest income years being those years, it would be after, and it'd be even bigger income because you've got the income from the oil being produced now, plus the income from the oil that was produced and warehoused, stockpiled. And so you don't lose the money, but your income from it might be delayed somewhat based on fluctuations globally. However, analysts right now say that the United States domestic market for oil and gas should be pretty healthy over the next couple of years because of current politics and prior politics and disgruntlements amongst these other nations and them not wanting to even send cheap oil to our country. So for the oil and gas market domestically, that's good news. It means you should have more along the lines of what's expected coming to you. All right, Mike, I believe there was one more question. Oh, you're on mute.
Sorry about that. Yeah, so this is actually the results of our poll that we took for as far as some folks needing kind of just business information. Some people have upcoming taxable events, which actually leads us to a different question that was submitted. Somebody's going to be selling their business and wanted to know what they might be able to do for planning for that event.
Very good. A lot of different things based on the sales price and based on how much is subject to capital gains. There's the age-old, simple, what a lot of accountants will help you with, just like an installment agreement. If you don't need all the money at once, just spread it over a few years, and then you're buying yourself time on when you recognize the revenue, because you don't actually receive it. Now, if you do want to receive it all at once, but not recognize it all at once, if the sales price is high enough and your capital gains tax is significant enough, there are other strategies that require really very specialized attorneys. And so they charge maybe 15 grand or whatever. And it makes sense if the tax savings is big enough to pay 15 grand or more, sometimes 30, 40 grand for them to help you save 200,000, 800,000, $2 million in taxes. And again, it all depends on what kind of business you're in and how much of it is subject to capital gains. So if you're in a manufacturing business and you have a lot of equipment and inventory and other things that are paid for, and you have an increased basis and a very small amount that's taxed, then there's some lower hanging strategies that are easier to implement, usually cheaper. If you're a tech company and your basis is almost zero and your gain that's going to be taxed is huge, you might need one of these higher strategies that are more expensive because there's fewer specialists. We might need to bring one of those in so we can help discuss how to offset And all of us here can help you determine whether or not that's needed. And so with a few numbers like my sales price, how much of it is subject to capital gains? Do I need all the money right now, or can I spread it over time? If I need it all right now, to get hundreds of thousands of dollars in savings versus some fees that we have to pay some third-party people who take the liability on themselves, meaning if the IRS ever contests this, they're the ones that talk to the IRS because they're the ones that guarantee the lifetime of this strategy for you. So a lot of things can be done. If you're getting ready to sell your business, there's probably 50 or so different strategies we can implement, and to know which one is right for you, we just need to get to know you a little bit better. First and foremost, your goals and objectives. When you sell, do you want to spend all the money right now? Or what do we need to do with the proceeds? That determines, that filters out a lot of our strategies in a way of it helps identify which ones work and which ones don't. So your objective with the money, or why you're selling. You're selling just because you're retiring, you're selling because you're at the peak, you're at the right time to sell. If you're selling, all these different things, we can help identify the right path. Anyway, appreciate everybody. Appreciate your time. If you want to know more information, again, our website, strategictaxsolutions.com. We just upgraded the security on the website, so it takes a little bit longer to load, but here soon it'll load much quicker after it's loaded in your browser once or twice. In addition, reach out to Dell, reach out to Todd, reach out to Micah. Any one of these amazing and talented individuals can help you identify or provide an analysis of some of these higher level strategies that might make sense, and then we can talk to see how to possibly implement them for you should they be correct. All right. Thank you everybody for joining. Thank you so much for coming, and look forward to talking soon.
Thanks, Jake. Appreciate it.
Thanks
All
again for having me.
right. Thank you everyone for being on. We'll talk soon.
Bye-bye.
Bye.